S&P 500 turning negative, the Dow and NASDAQ extending their losses after the release of the Federal Reserve minutes. Let's get more on the minutes and the markets. We're joined by John Vail. He's Chief Global Strategist at Nikko Asset Management. Welcome back, John.
Thank you, Fred.
The minutes, they were rather unanimous. They were unanimous. Every Fed policymaker saying they backed raising rates last month, and they're saying they're set to see rates rise further. Markets didn't seem to like that. Why not?
Well, maybe they were looking for something a little bit more dovish, but it seemed pretty clear at the time that that's what they were intending, the message that they were sending out. I think the minutes might be a little bit old news, though, by now because of the change in the stock market. They can see that financial conditions have tightened since they met. And it could be that going forward that they'll have a bit more cautious outlook on Fed hikes.
Speaking of Fed hikes, December, do you expect the Fed to go ahead with a December rate hike, or do you think that's a question?
We still do. I guess it really is a question of their forward guidance at that time. The market is priced in December pretty clearly. Obviously, if the stock market went down a great deal, that would probably not happen, though.
The U.S. market, you're a global strategist. Is it still the only game in town, or are there other regions that you like? It seems a lot of the strategists on our show say, hey, the only place to put the money is in the U.S.
I don't think that's true at all, really. I mean, the markets overseas are really quite inexpensive, a lot less expensive than the U.S., and yet earnings are growing there. I mean, you've got PE ratios for Japan down in the 13 level times forward earnings, and Europe's around that level too, and they do have earnings growth. The U.S. has outperformed, I'd almost say wildly, this year and for the last while. And there are cycles in U.S. outperformance, and it seems like we're sort of maybe at the top of one of those cycles rather than midway through it.
So would you say to U.S. investors to take some profit and put some of the money into, say, Europe or Japan or some other markets?
It does make sense to diversify internationally at this point. I think with the valuation differences, we see good stock market growth in most major markets. Emerging markets are a big question mark for us, though.
So developed markets, any ones that you particularly like, or sectors within those markets that you like?
Well, I think Japan looks especially good. Its economy is very strong. Its corporate earnings surprises have been very strong and upward. Of course, they're facing this VAT hike about this time next year, but we don't think that's going to be as much of a problem as it was the last time.
Last time was a big problem.
It was a bit of a traumatic affair for Japan. There are many reasons this time where it'll be a lot more smooth, we feel. So amongst sectors, I'm not a portfolio manager anymore for Japanese equities, but certainly there's industrial sectors. I'm not as keen to say which ones are better or not, but in terms of companies that have a lot of cash on their balance sheet, where we think that corporate governance is improving so much that they will use that cash more wisely, we're looking for companies like that.
Which would be what? Sectors such as the banks?
Well, some of them are actually smaller to mid-sized companies. It's hard for a U.S. individual or individual investor anywhere to suss these possibilities out, but we as a firm try to find small to mid-sized companies where they're actually changing their corporate governance and deciding to reward shareholders.
And in terms of the global outlook, you seem to be rather positive. Based on what? Is it the global growth of the economy? Is it earnings?
Well, it's true that we were probably a little bit too optimistic that when we met in September, at least so far. But the main problem has been the rise in the 10-year yield. And that's partly due to the Fed reducing its balance sheet and its holding of treasuries. Also due to some very strong macro data, especially what's called the non-manufacturing ISM number, which both its level and its prices paid, its inflation gauge, were very high levels. And since the service sector is a large part of the economy, the majority of the economy, that number really did shock the market quite a bit. And now the equity market is just getting used to treasuries trading at the 3.2 sort of range as opposed to the 2.9 range. And that has caused a derating in the U.S. stock market, but we think that with continued earnings growth, and the main answer to your question is earnings growth. I mean, corporate earnings around the world are just doing so well these days for many reasons that as long as you have good earnings growth, the stock market should go upward.
All right, we'll end it on that optimistic note. Thanks a lot, John. Our thanks to John Vail of Nikko Asset Management. I'm Fred Katayama, and this is Reuters.